let's audit Fort Knox. In other words, let's audit these 8,133 tons of gold. And I wish they would, because the fringes of the internet have been talking about, oh, there's no gold in Fort Knox for years. So go in there, count it. Germany and also the UK. Things aren't going well economically here. People don't necessarily have the confidence to go out and make investments. And since the last Commitment of Traders report, we've seen about 5 million ounces of positions liquidated as the gold price fell. That probably means that was the flush out of the leveraged positions.
Hello and welcome back to Soar Financially, a channel where we discuss the macro to understand the micro. My name is Kai Hoffmann, I'm the JR Mining guy over on X, and of course your host of this channel, and I'm really looking forward to welcoming back John Reade. He's a senior market strategist over at the World Gold Council, and you guessed it probably, we're going to talk about gold. Where's the demand coming from? What's driving gold higher? Is gold fulfilling its duties? What's gold all about? And I think a really important question we need to ask, what's the bear case? Because the move in gold has been absolutely, for lack of a better term, insane. I'm happy. I'm a gold bull. I'm really bullish on gold here in general. I get the bull case, but maybe we can poke some holes into it and see if there's some downsides. People have never lost money thinking about the downside. So let's leave it at that. Before I switch over to my guest, hit that like and subscribe button. It really helps us out, grow our channel, and it helps us bring guests like John onto the program. So thank you so much for doing that. Now, John, it's great to have you back on the program. It's good to see you again. How are you?
No, I'm very well, Kai. I think I'm probably one of the most busiest people on the planet at the moment, apart from somebody that can explain tariffs or basis swaps. I'm not sure.
Absolutely. I can imagine. I really appreciate you jumping on really a short notice here. We've only set this up the last 24 hours, so I tremendously appreciate the opportunity to have you on, John. Let's start the conversation. Let's set the basics here and maybe catch everybody up. Gold has been moving extremely well over the last 12 months, actually, and it's extremely violent since the beginning of the year. By violent, I mean in a positive direction, of course. What's the main driver behind gold right now?
Risk and uncertainty. Simple as that. I mean, gold has done really well in the last couple of years for a number of reasons, primarily emerging market demand of all types, whether that's central banks, investment. From time to time, even jewelry demand has been a big factor in the market. But things have changed. Things have changed basically since the election of President Donald Trump for his second term. What we're seeing now is the world getting worried. And when the world gets worried, people turn to gold. And we've seen that, play out in a number of different ways, not least of which through Western investors beginning to show signs of coming back to gold in ways they haven't really done so in the last 2 or 3 years.
I want to drill down on that in a second with you as well, but we've been running this channel since March 2020, and you guessed what happened then. And it's interesting because we've been talking about what is happening right now for the last 5 years, more or less. Questioning my sanity in between, of course, but it's all come to fruition. Like, have you seen the writing on the wall? Was it that obvious? Because people seem overly surprised right now.
I'm not sure. I mean, I've given up calling for a correction in equity markets in the States. I've given up calling for the recession in the United States because we've been looking for this for perhaps quite a long time, and it hasn't really come through. The fact, though, that the chickens are coming home to roost in global financial markets shouldn't be really a surprise to anybody. Large debts and deficits in the United States and other important Western economies have been looming for a while. And now we have a president who seems to be throwing the rule book out the window and maybe trying to take the United States back to the 1800s or the early 1900s with tariffs as a way of solving the world's problems. Well, it didn't work very well then, and it doesn't seem to be working very well now either.
It's interesting that we're using tariffs almost as an excuse for what is happening in the markets now. Are tariffs noise or signal for you, John?
It's an interesting one. They are noise. I think they're indicative of circumstances which have changed very much. Politicians, global institutions have a rule book which they play by. And when someone comes in and picks up a different playbook, everyone has to really adjust, particularly when that person is, the president of the United States, and that's still the most important economy in the world by a country mile. Yeah, maybe China's bigger in some regard, but in terms of financial markets, the US is the big dog in the room. And the big dog in the room is barking to a different tune at the moment.
Absolutely. And when I see so much noise in the financial media or just in general in the markets as well, I always wonder what else is happening that we're not paying attention to. And Ray Dalio said something like, warns that investors are too focused on tariffs and not paying enough attention to the breakdown in major monetary, political, and geopolitical orders. What do you say that? Are the tariffs just overshadowing basic flaws in what we've been seeing here?
I think that there is a bigger theme that's been playing out for maybe the past decade or so, and will probably dominate the rest of my life in financial markets. And that's that the US, for all of its strength and for all the fact I called it the big dog, there are other dogs in the pound as well. And China is becoming a geopolitical contender to the United States. And when you get to the stage when you have these geopolitical contenders facing off, the world becomes a risky place. And it's not just China too. I mean, there are other countries which are growing rapidly and are going to be really important going forward, particularly India, I think. I mean, this may be India's century rather than China's for demographic reasons. Certainly China's in the lead at the moment, but I wouldn't underestimate India's potential to become a genuine geopolitical or hegemonic threat to the United States over the next 20 or 30 years. And I think that's really what's been going on.
Just a quick follow-up to India, because I've been hearing talks about India for the last 20 years and hasn't really come to fruition. Besides demography and aging population in China and Europe and the US, of course, what else has India going for itself?
Well, India's made a number of really big macroeconomic changes in the last decade or so. There used to be a fairly contemptuous term called the natural Hindu rate of growth, which was like 4% or 3% per annum in terms of GDP. That's changed. I mean, they are the biggest economy which is growing at a decent speed, and maybe 6, 7, 8% over the next decade. And we've done a lot of work on India looking at the potential there because it's such an important gold market. I'll be frank, I'm actually slightly concerned about what we're going to see from gold demand, particularly from the jewelry side out of China because of demographics. But India is in really a sweet spot. If they can profitably and productively employ the demographic dividend that's coming through over the next 20 to 30 years, they're going to have an enormous increase in their GDP. And the structural changes that have taken place under Modi, not everybody loves him, but some of the things that he's put in place there have really galvanized the Indian economy, and it's been growing really well.
I haven't really been paying too much to India, but I've been hearing about gold-backed ETFs and things like that, physically backed actually, like proper investment products or bonds, not ETFs, sorry, gold-backed bonds as well, coming out of India. India's quite innovative when it comes to using gold as security. Is that something you see as well? You have definitely more insights here. That's why I'm asking, John.
Sure. I mean, India launched a few years ago sovereign gold bonds. So these were gold bonds issued by the government that paid a coupon, naturally attractive, but also guaranteed you the returns in gold. And they were a way by the Indian government to provide Indian citizens the ability to invest in something that's linked to the gold price, but without actually having to back them by gold. So these sovereign gold bonds have never been backed by physical gold. The idea was there to try and reduce the gold imports into India, take some pressure off the current account deficit, and provide a viable alternative to the demand for gold that Indians have had for decades. Now, they worked very well from an investor's perspective. They didn't work quite as well from an issuer perspective, because if you can think what's happened to the rupee price of gold over the last 3-5 years or so, and you're paying a coupon on that as well, these sovereign gold bonds have cost the Indian government a lot of money. So much so, actually, that they've stopped. They've announced that they won't issue any more sovereign gold bonds, and rather, what that's encouraging Indian investors who want exposure to the price of gold rather than to own the physical jewelry, it's encouraged those investors to go into exchange traded funds. So ETF demand in India is strong, and partly because they don't have the opportunity to invest in these sovereign gold bonds.
No, it's interesting. Like, you're definitely more in depth in that topic than I am. It's interesting to learn more about gold-backed bonds, because it's something Judy Shelton has been, advocating for, and I think we're interviewing her on our channel. I think next week or the 19th, I believe.
That
So
will be one definitely to listen to. Be interesting to see actually what she says as well. Gold-backed bonds, when they're issued and genuinely backed by gold, actually are not necessarily the panacea for the gold market that some people think they are. So yeah, we'll see what she has to say there.
remind me to ask you about Fort Knox at the end of the conversation, by the way,
Definitely.
John. I'm sure you've heard that question numerous times, but we need to get back to the current price action in gold and what's been happening over the last 48 hours. I'm puzzled. My head is spinning. It's really difficult to keep up in the markets as we speak. I think gold has moved. The S&P 500 is down 5.5% yet again as we speak, despite the rally yesterday. What do you make of gold's role in all of this? Because it seems like the only asset class that is actually performing the way it should.
Well, except perhaps for the end of last week and the beginning of this week, when some people might have been surprised that gold came under pressure. But for people that have been very close to the gold market through a number of crises, they haven't been surprised at all. And I'll tell you why. Gold performs well during safe haven events, during risk-off events like we're seeing at the moment, but not necessarily for the first day or two or week or two after a crisis. So if you think about the first quarter, the markets generally have becoming increasingly concerned about what was coming out of the news and the statements that were coming out of the White House and Washington in general. And that was fine. Gold was climbing under those circumstances, as you'd expect, as people, trusting gold as a safe haven. But then when all hell broke loose following the announcements of the tariffs, gold hit an all-time high on the 3rd of April, but then started to come under pressure on the 4th and 5th, the 4th and the 7th of April. And the reason for that, I think, is not because of something about gold, but something about wider asset markets. We started to see people reducing risk across the board, what I'd call a genuine risk-off moment. It becomes a question of selling what you can, not necessarily what you'd like to, just to reduce the risk that you're running, maybe to meet margin calls, certainly to reduce the exposure you have to financial markets. And look, gold is a big liquid asset market that tends to hold its liquidity and most of its price when bad things are happening. So it's only natural that people sell gold because they need to raise dollars or euros or whatever else. Now, to me, the interesting thing about this move was the fact that gold bottomed on the 7th, but then on the 9th, so the day that we had the famous reversal, it's like, oh no, we're not going to have global tariffs, we'll delay it for 90 days. But even ahead of that, gold had posted solid gains. And that tells me that there's a decent chance that the vulnerable speculative length that was in gold has gone. So in other words, the risk of seeing this liquidation of gold just merely to raise money may have passed us now. So again, today we're the day after the 90-day postpone everything and the massive rally that we saw in equity markets that followed. But guess what? Equity markets are currently down again. I think the S&P and NASDAQ are down something like 5%. And gold has gone on to hit its 22nd all-time high of the year so far. So I think gold is doing what it's supposed to do. It seems to have accommodated the profit taking that sometimes comes through at the beginning of the acute stage of the crisis. And maybe now we actually see gold performing better, because some of the things that have been missing from demand in the gold market in the last couple of years, particularly Western investment demand, may start to turn around.
Yeah, we'll touch on that in a second. Actually, the retail investor has been completely absent, and I'm curious what your thoughts are on that topic, whether they're coming back. But it must have been a wake-up call this week, of course. But maybe just an anecdote of what we saw yesterday. I was doing an interview. I was working, and I went upstairs to have dinner with my family. Came back 25 minutes later. The market was up 9%. But, and that is the interesting comment, because I've been in this space for 14 years, watching the gold market, and Mr. Slimy come around every morning at 8:30. We were all really negative in a group chat I'm in, and we said, well, okay, so the market is up 7% at the time. Gold is going to close red that day, and it didn't. And that was really, as exactly as you pointed out, really interesting to observe. And I want to get just a tad more granular on that, because why it didn't do that. And I'm really trying to understand that, because every single time we would have been right Yesterday we weren't. And fortunately, I'm not a short player. I don't do that. I don't play the short side. But based on experience and being hit over the head way too many times in the mining and gold space, I should have gone short, actually, seeing that market action in the main markets.
Well, I think what you need to pay attention to, Kai, is you need to pay attention to where the leverage money is in gold. Because for all the comments I've just made about Western investors having basically missed much of this move in gold over the last few years, speculators have been very much involved. So if you look at Comex speculators on about the 1st of March last year, and I remember it well because it's my birthday and I'd taken the day off, that was the day that gold broke out. It crossed a few technical levels. We saw the commodity trading advisors, or the CTAs on Comex, all start buying gold. And that was what took gold up through $2,000 an ounce, and then took us up to about $2,400 an ounce. They bought loads of gold and remained long gold basically all year, and maybe took some profits ahead of the election. So they're really important in terms of the short-term direction of gold. And they still held decent-sized positions running into Liberation Day. So that's the sort of money which gets liquidated. And okay, we look at the commitment of traders report. It tells us what those positions are, but they're always a bit out of date because, they released them on Friday as of positions last Tuesday. So, it's difficult actually to have a real clean idea of where those positions lay. But what you can do is you can look at also Comex open interest, the aggregate open interest, the total open interest, and see whether that's falling. And since the last commitment of traders report, so that's as of last Tuesday, we've seen about 5 million ounces of positions liquidated. So aggregate open interest has fallen as the gold price fell. That probably means that was the flush out of the leverage positions. And, they haven't been eliminated, but 5 million ounces, or about 160 tons, a lot of gold to come out in the market, probably shows a lot of why we've seen the weakness in the price. Now, the good thing about this, we will know more categorically on Friday afternoon when this data comes out from the CFTC. But for now, it's supposition on my part. But I, having seen that decline in open interest, I was not entirely surprised that gold managed to hold on to its gains. Because, as I say, I think the vulnerable longs are out.
Now, interesting, because I've been looking at the bond market as well there, John, and surprisingly, the U.S. 10-year yield chart looks exactly like the gold chart. And I wouldn't have expected that, because I would have expected maybe yields to drop and then spike, but do the opposite. Like, yields are spiking right now, 4.4% on the 10-year roughly, moving in the opposite direction. It seems like people are moving money out of the bond market for whatever reason, we can speculate on that, into potentially gold, because it's not the dollar either. It seems like gold is the only safe haven investment out there right now.
Traditionally, you're absolutely right, Kai. You would expect in a risk-off moment that the dollar would strengthen and that bond yields would fall, US bond yields would fall. And personally, and look, you're right, I'm spending a lot of time looking at fixed income markets, and there's lots of intricacies going on there about basis trades and all manner of stuff. But to me, let's just cut to the chase. The safe haven asset of the world's financial system, the 10-year treasury or the treasury market more general, isn't behaving like it should. That tells me that people have reduced faith in the US. Gold is now behaving as you would hope it to be. And obviously, gold's a much smaller market than the treasury market. But for the fact that gold is doing well in this environment and treasuries aren't, and the dollar's weakening, tells me that things have changed in the global financial order. And I think this will only benefit gold going forward.
Yeah, absolutely. Your fellow countryman, Alistair McLeod's been telling us, it's what do you call it? I'm missing a word here, but constantly telling us it's not the value of the gold going up, but the value of the dollar going down. Right.
Well, that hasn't really been the case, actually. We've seen gold go up in every currency over the last few years. Things have changed in the last few months, but to me, this is the big warning sign. When people start to lose faith in the US dollar, and arguably for good reason, because of the frenetic comments that we've seen out of the White House, and the implicit threats that tariffs and other actions potentially mean, then investors should take note. The dominant status as the US dollar as the reserve currency of the world and as the most important financial market depends upon trust. And I think that trust has been eroded to a fairly large degree in the last few months. And I think gold will benefit as a consequence.
Yeah, absolutely. Trust is really difficult to come by these days, and even like the 30-year, trying to understand why would it get paid back? And that's a whole different discussion. Like the U.S. debt, whether they're going to default or not, is a different discussion. But just trust and uncertainty is way too high. The VIX has exploded. Just the volatility index. There's just no trust at all. Really interesting. Like the reason why I reached out to you, and I always forget to schedule all our conversation way before, because you guys put out, you guys meaning the World Gold Council, apologies, put out the ETF demand and the your gold commentary pretty much like clockwork on the Monday or Tuesday, the second Monday or Tuesday of the week of a month or so. So I was of course triggered by it, and you put out your commentary just the other day. What was the most interesting aspect from that? Anything that surprised you? Anything that jumped out at you?
I guess the thing that I know as a result of the ETF flows in the first quarter is I already know what our quarterly publication is going to talk about, even though we haven't written it yet. So we write gold demand trends each quarter. We get the data coming out, given to us, and I've had the first lot now, and we'll get the second lot next week. And then we write the report. But I already know what the headline's going to be, because ETF flows come out on a daily, weekly, monthly basis. We've seen 226 tons of inflows into ETFs, and that follows 4 consecutive years of outflows. If I look at the first quarter of last year, we saw outflows there of about 170 tons, I think. So the gold market's about 5,000 tons a year, 1,250 tons a quarter. We've seen a swing of 400 tons of the actions of ETF investors this quarter, first quarter 2025, compared to 2024. It explains, I think, a lot of the positive price performance of gold. So that to me is really important. Now, I mentioned before, Western investors have mostly missed out from the moves in gold over the last couple of years, because bar and coin demand has been pretty weak. Even negative in some quarters in Germany and German-speaking Europe. US demand isn't as bad, but it's probably down 55% over the same sort of couple of year period. So the man on the street, the woman on the street hasn't been buying gold as much as the emerging market investors have been, and they haven't been taking advantage of this big increase in price. But we begin to see the turn in ETFs. Now, ETF investors could buy decent amounts of gold for years to come, if you consider how much equity markets have performed in the last few years. So I think that's a really interesting thing that's taken place there. And even in the first few days in April, yes, there's been volatility, there's been profit taking on some days. We saw a very healthy inflow yesterday of buyers of gold via exchange traded funds. So I think Western investors are beginning to wake up to gold, and I'm looking forward to seeing that confirmed by the physical buying, the bar and coin buying in Western markets as well. Although so far, it still remains fairly quiet on that front. I still think equity investors in America are still trying to buy the dip. And when they stop trying to buy the dip in equities, maybe they'll start to think about buying some gold.
Yeah, sector rotation of funds. 401k money needs to get scared. And I think we're almost there. We're almost there.
Well, we'll see. It's always hard to predict the psychology of investors. Buy the dip, or BTFD as it's known, has become a very ingrained habit of investors who try and, who have succeeded and made great money from buying dips in equity markets over the last few years. We'll see whether they continue to try and do that.
I think we need to apply that to the gold space now and the gold price, quite honestly,
well,
and silver to a degree as well.
That's one of the big things that we've noted about this rally in gold since March last year. Every time the gold price has corrected, and when there's a lot of speculative money in the price, you expect the gold price to sell off from time to time. You get some strong economic data, or the dollar rallies, or rates move, and you see a flush out. Usually lasts a number of weeks, but it hasn't. Since March last year, the sell-offs have been short and shallow because somebody really is buying the dip. I think that buying of the dip has been central banks and to a certain extent the jewelry sector. But it's been very interesting to see just how resilient gold has been since March last year, whenever you've seen a correction.
Before we get to the central banks, quickly EU ETF flows, which is puzzling to me a little bit. But I'm curious. I'm going to ask you. It's a hypothesis I have, or a thesis. Was it a recession indicator that the EU is in recession? That because I think for the longest time ETF saw outflows out of Europe, while the US and China were buying. US was behind China or Asia, as per your metric, for the longest time as well. But they started buying around September, October. I might be wrong on the month here, but
Yeah.
but Europe only started buying really now in March. I think they were.
Yeah, I
not,
mean,
right?
we've seen erratic flows in the second half of the year from Europe, and I think interest rate cuts have helped. But I think overall, I mean, the way I think about it is certainly Germany, which is one of the biggest markets, and also the UK. Things aren't going well economically here. People don't necessarily have the confidence to go out and make investments. They're trying to make ends meet. And the fact that high interest rates, high by standards of the last 10 years, prevail throughout Europe, has meant that investors have had an alternative for the first time. I came across many ETF investors over the last few years who had turned to gold because they didn't want to pay negative interest rates when they were buying government bonds. So, I'm not surprised we've seen profit taking from some of those. They bought gold, it's done very well. And hey, now they can invest in government bonds at positive nominal and even real yields. And therefore, some of that rotation makes sense. What we probably need to see is, again, the man and woman on the street return to buying gold. If they're buying it physically, they're probably buying it via ETFs as well. Personally, I think some of this choppiness we've seen in ETF flows in Europe probably have been resulted to profit taking rather than actually negativity about gold itself.
Yeah, I don't think it was gold related itself. It was really, as you said, like more of a recession indicator almost.
Yeah.
Europe was doing way worse than the US, but the US wasn't a strong buyer either until recently. Actually,
but I think there it's fairly clear. Last year, you didn't need to own gold as a diversifier. You just needed to pick the right Mag 7 stock and you'd make a load of money. When equity markets are performing really strongly in the US, people don't think they need to diversify. They don't need protection. They don't need to spend money on a hedge. They just need to buy more of the stuff that's going up a lot. And that's where things can turn around quite quickly now if you look at the performance of equity markets in the States.
John, I could talk with you for hours. I got a few more topics I need to discuss with you here. Central bank buying is definitely one of them.
Sure.
Where's most of the demand coming from? Is it still China?
Emerging markets so far.
Yeah.
I mean, it's emerging market central bank buying that has been a feature since the global financial crisis, and that emerging market central bank buying continues at the high rate that we've seen, the doubled rate that we've seen since 2022. I expect that only to increase from here. Because if you were worried about or if you were concerned about holding US dollars previously, you now might be worried. And therefore, that I think will encourage more central banks in the emerging market space to diversify into gold. And hey, there's a number of countries that used to think they were allies of the United States that now aren't quite so sure. And if they don't have as much gold in their portfolio as perhaps they used to have, then maybe they'll be thinking about selling some of their US dollars, their US dollar assets, and buying gold as well.
What do you make of Poland buying so much gold? And how does that fit in? Because I think that's a name or a country nobody really has on their bingo card. But weren't they the largest buyer, at least in the EU, of gold?
They were the largest buyer of gold last year out of all the disclosed purchases, in the world. Why? Because it is a successful, up-and-coming, growing European country that looks upon its neighbors and looks upon Germany and France and sees how much gold they have in their reserves and thinks, well, that's what you need to do to demonstrate that you're a successful European economy. Poland's been one of the real successes since it joined the European Union and is a real dynamic economy. It also is very much aware of geopolitical risks. I mean, its neighbors and its neighbors' neighbors are a bit closer to the troubled areas than perhaps we are sitting in further west in Europe.
Yeah, no, absolutely. It's really difficult to have that feeling of perceived risk there. They've been ramping up their armies and all of that. And maybe we'll touch on geopolitical risk here in a second as well. But the gold flows back into the U.S. I think we need to discuss those.
Sure.
Which is a big topic. I think I'm really curious to get your take on it without tainting it with my blurred vision here.
Sure. I mean, let me talk about what's happened there. There has been an enormous amount of gold that's traveled from Europe basically comes from London, goes to Switzerland to get re-refined and recast, and has ended up in depositories associated with the Comex futures market in the States. This is not investment demand in the United States. It's not consumer demand. It's not feedstock for a jewelry industry. What this is the gold trading industry pre-positioning its inventory, which it usually holds in London. It's been moving it to the United States in case there are tariffs on those flows.
So it was really tariffs.
It was a insurance policy that they took out in case tariffs were placed upon gold. Now, the reason it works like that way, you have investors and speculators on the Comex futures market who are long gold almost all the time, and they've had decent sized positions, as I've explained. Who are the shorts against that? Because it's a futures market. For every long, there has to be a short. So who's the short? The short has been banks and other financial intermediaries. But that doesn't mean that they're short gold overall. They're short Comex futures. They're long gold as a hedge in London. Why London? Well, it's the center of the gold wholesale market, and it's cheaper to store gold in London, and you can do more with your gold that you have there. And it's fine, because if you don't normally need to deliver much gold into those futures contracts. Most people buy Comex futures for the price appreciation, not as a way of getting their hands on physical gold. But if you suddenly think, if I do need to move my gold to the States, I'm going to have to pay a 10% or a 25% or 156% tariff, whatever the latest numbers might be, then suddenly I can't move my gold almost for free to the US. So I better move it before these tariffs come in. And that's exactly what happened. So gold traders moved gold into the US so that they can deliver against any demand that comes from maturing futures contracts or first notice day on futures contracts. And that gold will probably stay there, because we know what the tariff ruling is today. We have no idea what it's going to be tomorrow or even at six hours time. So who knows? So the gold will stay in the States. It caused a temporary shortage of immediately available gold in London as well. Not because there's a lack of gold in London, it's just that most of it's in the Bank of England. And the Bank of England, like any other government organization or bureaucratic organization, doesn't have the ability to be able to scale up its activities 4 or 5-fold. So suddenly, when the banks in London need to get their gold out of the Bank of England, please form an orderly queue. And that's exactly what happened. So the orderly queue caused a shortage of gold in London, caused gold interest rates, the cost of borrowing gold, to spike, but that's all returned to normal now. There's probably enough gold in the States. In fact, I think there's too much gold in the States, and you probably will start to see those New York stocks of gold start to decline now. And the gold markets, it's been a huge story for the gold trading market, and it's attracted a lot of attention, because there's nothing like flying hundreds of tons of gold around the world for the newspapers to pick up upon it. But it hasn't really affected, anybody's ability to buy and sell or trade gold. And I don't think it's actually been responsible for much of the price of gold increase as well.
It was a nice, it seemed like almost a perfect storm for gold, and which made me personally a little bit nervous. And again, as I said it at the intro, like I'm bullish gold here in general, because I get the macro factors that are weighing on gold or pulling gold higher. But Joe Rogan, Elon Musk, Donald Trump, Scott Bassett, everybody talking about gold and the gold in Fort Knox, and there's so many things that are hitting the gold market at the same time. Sure. That I was worried about too much hype in the gold
I worry too, Kai. I worry when US politicians or people close to US politicians talk about the gold that the US owns. They're the biggest holder of central bank gold, 8,133 tons, they say, compared to the next biggest holder, which is Germany, which is 3,259 tons, I think. So this is huge. Annual production, 3,600 tons. So more than 2 years of production held by the United States. And I wish they wouldn't talk about it. Because when they don't talk about it, when they forget about gold, the chances of them doing anything with gold is very small. Now, there's a number of things they could do. There's been talk about, let's audit Fort Knox. In other words, let's audit these 8,133 tons of gold. And I wish they would, because the fringes of the internet have been talking about, there's no gold in Fort Knox for years. So go in there, count it. We run 2 ETFs, the GLD and the GLDM ETFs in the United States. We count every bar well, rather independent auditors count every bar every year. And I know how much of a job that is. We do a sample count every quarter. So counting 8,133 tons is a big job, but do it. Prove to the world that the gold is there. And if it's not there, then it's hardly bearish gold. It probably is.
Can I jump in real quick, John? Like, who would you trust to count that? Who would the public accept?
There's lots of it. Look, there's lots of independent people out there. There are people that specialize in vault examinations and counting bars. There's auditors out there that audit company financial statements. And if you're an investor in a company, if you don't trust auditors, you better be really careful what you're doing. So yeah, there's lots of independent people out there that do this for a living. And as I say, we see who audits ours. Use them; they're good. Got strong men down there picking up gold and moving it.
What's it called? No spillage or anything, no loss every quarter. It's like, oh yeah, we're missing a ton here. We're missing a few hundred grams here and there.
No, you count it all, you do it properly. And look, I tend to believe Western governments when they say what they say, because in my experience, when I was at UBS, I've dealt with a lot of central banks when they were selling their gold and a few central banks when they were buying their gold. They pretty much reported what they had and what they did at the right time, maybe a few timing issues in terms of disclosure. The Western central banks do seem to do do seem to tell the truth. Why should the US be lying? And I guess the other thing I'd say as well is I know the gold market very well from the inside. If that gold had been sold, somebody would have gossiped about it because they always do. And it would be such amount of gold that had been sold over the years and would have had to have been refined and would have had to find its way into markets. We'd know about that.
Good, really good point, because gold is shiny and you want to brag about it. Absolutely. Right. One last I have two questions left for you. One is a bit of facetious one, and I'm not sure you can answer. I want to answer it. Is like, how much gold does China really own?
I don't know. I mean, and we don't speculate on what central banks do. But what I would say is there's a number of commentators out there that are talking about the fact that China seems to be buying more gold than it's reporting. And, one in particular, Jan, I think it's Nieuwenhuizen, or Jan Gold as he used to be, has done some good studies about flows of gold, which seem to stand up. So, for those of you that want an answer, I wouldn't come to the World Gold Council because we're not going to speculate. But other people have done some good work there, and it's worth paying attention to that.
No, fair enough. I was a little iffy. I wasn't sure if I should ask you that question. So, but I mentioned in the intro we quickly need to talk about a bear case for gold. I think everybody understands why gold is going up. Risk, uncertainty is just the easy ones. You said it in your first answer. But what's a bear case for gold realistically? And realistically, I think is the key word here.
Well, you're right. Everybody I speak to is bullish gold. And that does worry me sometimes because when everybody is thinking the same way, you do worry about the counter case. I was talking before about the US and what it's saying about gold. I don't care about Fort Knox. If anything, that's neutral to positive potentially. I don't care about the US revaluing its gold because it values it at $42.22 an ounce. And if it revalues it to, $1,300 or whatever, who cares? That's an accounting transaction. Sorry, not 1,300, 3,100. Yeah, shows how long I've been in this market. But I don't care because it's an accounting transaction, and you don't have to revalue gold in order to sell it. And just because you do revalue it doesn't mean you're going to sell it. What I do care about, though, is if the US does anything to sell any of its gold. And there are a number of advisors or people well connected with the US administration that are suggesting that the US should sell some of its gold in order to fund a strategic Bitcoin reserve. Now, one of the biggest stories that has been helping gold in the last few years has been this big uptake in central bank purchases. If the US, as the holder of the largest stock of gold in the world, were to announce a gold sale, that changes that narrative. That's the bear case to me. I think it's a small possibility, but that's what you should keep your eye on because that would change the sentiment towards gold in a heartbeat.
No, fantastic. John, we need to talk more often. I really enjoy your views and really it's like you're at the heart of it all. You got your finger on the pulse. Like I called you the godfather of gold before hitting the record button, but it's true. Like You have really, really great insights. We need to do this more often. Really
Well,
appreciate
absolutely,
your time.
Kai. All I would say is I don't cut off the heads of horses, but I am quite connected to the gold market. And look, this has been my life for nearly 40 years, and I love talking about it. So anytime, just give me a shout, and if I'm in the country and I can sit in front of a computer, I'll do it.
Fantastic. Really appreciate it, John. And I know you have a really active Twitter or X profile as well. You're quite active on there. So it's really interesting to see sometimes your name pops up when you reply or retweet something that I agree with. And it's interesting. So
Good.
To say the least, because you can't always talk about everything, but you can write about it. So John, I appreciate your time. Thank you so much for tuning in. And everybody else, thank you so much for watching Soar Financially. It is much, much appreciated. Hope you enjoyed this conversation with John Reade. He's senior market senior strategist over at the World Gold Council. I tremendously enjoyed talking with him. He's got the finger on the pulse. He's got the data. Nobody better to ask if you ask me personally. Let me know what you think. Put it down in the comments below. And if you haven't done so, hit that subscribe button. It helps us out tremendously, and it's a free way to support us. It helps us bring guests like John on the channel. Thank you so much for tuning in. We'll be back with lots more. Stay safe out there.